Okay. And so game plan for tonight is to finish chapter one. I know that towards the end of our session last week, I said, oh, we'll definitely get into chapter two. But as I looked at that first module of chapter two, there's no way we could start that and finish that tonight. So I think it's, that makes some sense. It's probably wise to take the time we have tonight, finish chapter one, and then we'll hit, the ground running, starting chapter two next time. Okay. All right, good. So let's go ahead and take a look, and we're continuing on with the reporting objectives in this chapter. And what we're going to start with here in module 8 is what happens if an auditor gives, say, a unmodified, unqualified opinion in, say, 2023, and then 2024 comes along, and for some reason they have to have given some sort of modification, qualification, whatever. And we're dealing with comparative financial statements. We're showing 2024 and 2023 right next to each other. Well, we're going to see how we'll have to take, and by now, I think you're seeing the importance of memorizing the standard unmodified, unqualified opinion, both for public and non-public companies. We're going to look at how we will change that in a circumstance like that. The other thing we're looking at in this module is sometimes we become engaged in an audit where we may be the group auditor, we may be auditing the consolidation, but there may be other auditors. We call them component auditors that are auditing pieces of the consolidation. We're going to see how that's going to affect our reports. Okay, so that's what we're looking at in this module. And so we take a look and then we say when comparative financial statements are presented. Again, comparative financial statements, I think are a situation where we would show 2024 and 2023, often in column or format right next to each other for comparative purposes. The auditor's report should refer to each period for which the financial statements are presented and on which an opinion has been expressed. We're going to call out both years in the report. And we say that because the report date for the audit for the most recent financial statements is going to be used, the auditor should update the audit reports on previous statements issued. Now, update is a fancy word for saying, hey, look, if you haven't had anything that would cause you to want to change your opinion from that previously expressed, you simply reissue your opinion. But you must call out both years in the audit report when you have comparative statements. Now we come over and we say here that the auditor, okay, I just want to come down to this next paragraph. Okay, we come down and we say that the this next section, the auditor may have differing opinions on different years. Okay, at least it used to say that. Here we go. The auditor may express a qualified adverse emphasis of matter, other matter, explanatory paragraph with respect to one or more financial statements for one or more periods, while expressing different opinions on one of the other financial statements being presented. Sorry, guys, I thought that was in there, and it took me a second to find it. In other words, picture's worth 1,000 not very well written words. Okay, so what happens? Let's say that in 20x1, 20x1, let's say, is showing with comparison to 20xo. Okay, now let's say in 20xo, we had an unmodified, unqualified opinion. Okay, but for some reason in 20x1, we have to qualify. How would the audit report look under those circumstances? And we're covering both periods, X1 and XO. Okay, so we're calling out both years. And then what we say is, in our opinion, Okay, in our opinion, the company 20X1 financial statement is not capitalizing certain lease obligations as described in the basis for the qualified opinion report of our report. The financial statements present fairly and material mistakes the financial position ABC company as of December 20X1 and 20XO. Okay, so what happens? And the results of operations, cash flows, years, then ended, accepted. Okay, so notice we use the except for phrase. Okay, and we call out the problem with the X1 statements. Okay, whatever year is affected by the problem, that's where you aim that except for phrase. And so you say, hey, except for the effects of 20X1. And it's just like if you had a qualification for 1 year, you call it out for X1, and then you just carry on and you finish the rest of the audit report the way you've memorized and saying that what for XO, the results of operations, the statement of cash flows, and you just limit your qualification to the 1 year. Okay. Now, when you come over into the basis for the qualification, notice when we're in there, we're not saying anything about the X1 statements because the qualification didn't affect the X1 statements. It only affected the XO statements. And then after that, the rest of the audit report is exactly as you've memorized. And that's why I keep pushing, guys, the importance of memorizing that unmodified opinion, because if you have to start to change it for different reasons, you don't want to be tangled up and trying to, go from scratch on that. You simply insert where the changes need to be as you start to answer questions on that. Okay. Now we come over, and if we're talking about I just want to come down. It's the same thing with disclaimer. You just call out the year associated with the disclaimer. But when you come out and we're talking about public company, okay, for public company, again, we use the phrase except for, okay, in our opinion, except for the effects on, and here they're using 20X2 is the year they would have the qualification. So X2 is qualified here. And in this example, X1 would be the unqualified, okay? And they're just calling out the problem as to X2. They give that, and remember, we have the explanatory paragraph, and in the explanatory paragraph, we're not explaining problems with X1 because we were fine with X1, okay? That's a U. X1 is unqualified, it's X2 to which the qualification issues relate. The rest is exactly as we've memorized. Okay. All right. Any question on that? Okay, good. Then if there's no question on that, let's go ahead and let's take a look at our next section here on updating, changing prior opinion. Okay. So let's just have a little pretend story that'll go along with this. Let's say I'm the auditor of your financial statements, your management, you're the board of directors. Let me put you on the board of directors for this one. Okay. And I come to you and I report to the board of directors and I say, hey, look, we have to qualify the opinion for 2024 financial statements. Okay. And you accept that and you say, okay, qualified opinion. Let me ask you a question and I expect a response. Are boards of directors happy when there's a qualification on a company's financial statements? Are they okay with that?
No.
No.
Generally, what happened, right? This is not something they want to see. So they're going to maybe go to management and say, what happened? Can we fix this? And management would likely say, yeah, it's going to take us some time though. So the auditors go ahead, issue the qualified opinion. And then at some point before we issue the next year's statements, they show me that you show me that you have corrected the problem. You give me the evidence I need to support the new information. Is it okay for me to say, well, my opinion last year was qualified, but now it's unqualified? Would that be okay? Is it
Can you
okay
hear
if
me
I
now?
change my opinion, huh? In the condition that I just called out, would it be okay for the auditor to change your opinion? What do you think?
Professor, if it changes his opinion, does it fall under the ethics of auditing?
I didn't quite get all that. Can you say that again?
Like if the auditor changes his opinion, and does it fall under the ethics of the doing audit procedures, or it may affect it?
I mean, I'm having your mic's not something I can really deal with, but I'm sitting here and I I had a qualified opinion. I come back in the next year, and so I had, let's say I had audited 2020, I'm coming in 2024, 2023, 23, I had a qualified opinion. 24, we'll just say I'm unqualified opinion, I'm unqualified. Okay. And then when I come back, you show me the 23 statements again, and you say, look, I fixed that problem. And I look at that, you show me the evidence, and I see that it is corrected, and there's the correct evidence to show me that the amounts are right in the financial statements. Is it okay for me to do this?
Yeah, you can
Change my
update your opinion.
Yeah, I can change my opinion. Thank you. I can change my opinion, but the focus here is, well, what would be the structure for changing that opinion? Okay. And they got rid of the mnemonic. I thought it was cute that only dorks change their opinion. Okay. But flashcard, what I would have to do, I'd have to say, this was the date of my original report for X3. My opinion was qualified. I'm changing because they've shown me the evidence now that they have properly accounted for something. That's the change that has occurred. The reason for my prior opinion was they weren't capitalizing some leases. Changes have occurred. They fixed that. They've shown me the evidence and whatnot. So now my opinion is different. It is now what? It is now, in this example, unqualified instead of qualified. Okay. So the sample paragraph that would contain those elements that we just talked about is given to you here, but that would basically be included as a other matters paragraph, emphasis of matter or other matters paragraph for non-public company, or explanatory paragraph for the public companies. And it would follow the opinion paragraph. Okay, be careful with location of paragraphs, guys. Make sure you're putting that on your flashcards, because that's something that can kind of drive you crazy. You start missing questions simply because you didn't know the location of an explanatory or other matters or emphasis of matter paragraph. Okay. Okay, good. Come over and report of predecessor auditors. Okay, so what happens here? Now what's happened is you audited. By the way, this report contains the elements that are talked about up here, so you don't have to memorize the report exactly the way it's written there. You just need to know where to locate and the elements of what goes into that additional paragraph that's put in there. You don't have to memorize it the way this is. I want to put the box around that. I don't want to indicate that you should memorize it, but you may read that for fun and see that it does contain the elements that we talked about, the dorks elements. Okay. All right, good. Now come over and let's continue story time here. Let's say you audited 2023, and I'm going to take over your client and I'm going to audit 2024. In that situation, you would be the predecessor auditor. I would be the successor auditor. Now, as the successor auditor, I have some decisions to make because I'm going to issue my report for 2024. We have comparative statements, okay? And my options are to either present your report to show it, okay? So I will simply have your report and my report side by side. Here's your report for 23, here's my report for 24. Or I could make a decision to, and we say predecessor not reissued, in other words, not presented. Okay. So those are the options. Now, let's say going back to the option of presenting it. Okay. I say to you, I'd like to present your report. I just want you to reissue your report and have it sit right next to mine. And you say, okay, that's fine. But if you say that's fine, then you, the predecessor, okay, and the onus falls on the predecessor to do certain things before you just let your report be reissued, be published right there next to mine. One, you would read the statements of the current period. In our little example, that would be the 2024 statements, okay? Because you might see something there that says, well, wait a minute, that doesn't jive with what I understood was the situation from last year and may lead you to want to change your report, okay? Same thing with comparing the statements between the 2 years. Maybe you'll do a set of analytical procedures saying, well, wait a minute, why did revenue jump? Was it wrong last year? Or why did it drop? Was it wrong last year or is it wrong this year? What's going on? Okay. Then you're going to start to ask for a letter of representation from me, the successor, and see if I'm aware of any matters that were revealed about the previous year's report. Okay. I have 365 days of hindsight, and if I become aware of something that indicates that your report should be changed, I would be obligated to tell you that. Okay. And then management will give you a representation letter that they're not aware of any changes that need to be made. So you get all of these things that are on this flashcard, then it would be okay for you to green light me to present your report. I would simply put your report next to mine. Now, let's say I'm looking at that and I'm saying, hey, that's quite a bit. That's too much. So I think I'm just going to go ahead and not reissue your report. Now, I can't go back and do last year's audit. So what I would do is summarize what happened in your report in my report for the 2024-23 statements at that point. So now the onus falls what? On the successor, okay? And the successor would express an opinion on the current year's statements, okay? And indicate in an other matters paragraph for a non-issuer, explanatory paragraph for an issuer. And I basically would call out these elements that you should flashcard here, okay? In my report, I'm going to sort of book report it, right? I'm saying the predecessor auditor should not be named specifically in the successor's report unless the practice was acquired. So that's a flashcard inside the flashcard, okay? Then book reporting it, I would say the type of opinion expressed by the predecessor, what was it? If it was modified, what was the reason? The nature of any emphasis of matter or other matters, explanatory paragraphs in there, and the date of your report. So I simply book report. I summarize your report in my report. Okay. Flashcard those elements, but I don't name you by name unless I acquired your practice. I guess you could put that all in the same flashcard. I don't know that you need a separate one for that. Okay. Okay. All right. Good. Now, what happens if I audit the 2024 statements? Okay. So I audit it and I give an opinion on the 2024 statements. A stands for audited. I'll just write in audit. Okay. And then in 2023, I simply reviewed the statements or I compiled. the statements. Now, you look at that and you say, John, what the heck is a review? What the heck is compiled? Okay. There are other services that CPAs can give that are less in scope than an audit. Okay. An audit gives a positive assurance that, in our opinion, the financial statements are fairly stated. A review gives a lesser level of assurance called a negative assurance, in which we say we're not aware of any problems. And a compilation disclaims an opinion on the financial statements, but we still issue a report. We're going to cover these in detail in A6, but what's going on is we have two different levels of assurance, maybe no assurance in the case of compilation, maybe negative assurance in case of review, right next to statements, and we're giving a positive assurance, which is the highest thing on the food chain. Okay. So when that happens, when the current period financial statements, prior period financial statements, I should say, are reviewed or compiled, and are presented in comparative form with prior period statements that were reviewed, the current period is audited. Prior period statements are reviewed or compiled. Okay. And the report of the prior period is not reissued. The auditor should include an other matters paragraph or explanatory paragraph or issue in the auditor's report that includes the following. And let's go ahead and let's flashcard that. Okay. The level of service that was performed in the prior period, the date of that prior period. If there were modifications, and we're going to talk about how we may modify a compilation report, how we may modify a review report if we identify certain things. You had to do that. What were they? A statement that the compilation review is much less in scope than an audit, and a statement that no opinion or form of assurance is expressed on the financial statements if it was a compilation. If it was a review, then we would have said, hey, it's less in scope and we're not giving an opinion, and we don't get into the whole issue that it's negative assurance and stuff, but we say that it's less in scope. If it's a compilation, we say, hey, we're provided no assurance on that. Okay, flashcard that. Okay, now you come over and let's take a look. And if the prior statements are not audited, reviewed, or compiled, so now we have what? 2024 is audited. I'll just put an A there. And 2023, nothing was done. Okay. If you have that situation, let's flashcard that. If the prior period statements were not auto reviewed or compiled, the financial statement should be clearly marked, and the auditor's report should include another matters paragraph or explanatory paragraph did not audit, review, or compile the prior period statements. Okay, and assume no responsibility for them. So I think you're getting the theme here, guys. We're doing basically what we've talked about for the standard report. And then we're starting to add things in through other matters paragraph, through emphasis of matter paragraph, explanatory paragraph, if it's a public company, about these different things. Okay. All right, good. Let's take a look at a multiple choice question here. Why not? Okay. So let's look at this one. I'll put the poll up. Okay, looks like everyone's had a chance. Okay, there goes my last student in. Okay. And we got 75% on this one. The answer is A. Okay, but let's take a look at this a little bit and see why maybe some folks thought B was the answer. I don't think anyone picked any of the other choices. And we say when reporting on comparative statements, an auditor ordinarily should change the previously issued opinion. Okay, so they're telling us you should change the previously issued opinion if what happens. Okay. And we saw the correct answer was the prior year's financial statements are presented to conform with the generally accepted accounting principles or restated. Yeah, they fixed it. They fixed the problem. Show me the evidence. I'll change my opinion. I have to have those elements of the date of the report and whatnot. What was the reasons for the other opinion and so on. Okay. I have to have the dorks things. You want to use that mnemonic. Okay, but I would basically issue or change my opinion. Okay, now B, auditor is a predecessor auditor has been requested by a former client to reissue the previously issued report. I'm not sure why you guys picked B. I mean, some of these answers are so weird, I can't even explain why they're not right. Does somebody want to say something about why they thought B was correct? I mean, that's just, for me, that's just too weird. I can't even explain. I mean, that's just wrong. Okay,
No,
yeah, go ahead.
I'm sure about the generally accounting principle change. So I was tied between A and B, kind of just guessing between those, alone.
Okay. I mean, my problem
Me
is
personally.
that B is like, I asked somebody to play Mary Had a Little Lamb and they went and banged on the piano and then said there. And I'd sit there stunned going, okay. So I'm just not sure. I can't I can't say why it's wrong because it's just so wrong. There's nothing that would make that right. Okay. So the takeaway here is what, hey, prior year statements were restated conforming with GAAP. They show me that. I changed my opinion. That's perfectly acceptable and I don't know how common it is, but it's certainly acceptable. Okay. Good.
Professor,
Yeah.
I have a question in this, specifically the answer B. The Let's say that I am the predecessor auditor and you are the successor auditor. The only one who can request the predecessor auditor to reissue the previous report is the successor auditor, right? Instead of the former client?
The auditor is a predecessor auditor and has been requested by a former client. No, no. I could ask you to reissue the report and change the date on the report.
Oh, okay.
But I wouldn't be changing my opinion if I'm reissuing a previously issued report. So that's kind of what's wrong with B. I wouldn't be if I'm changing the report, I'm not reissuing it. Okay. So in other words, let's say the only thing you want me to do is change the date of my report. Let's say you got last year's audit and the date of the report was January 15th. For some reason, you want a date dated March 31st. A bank or something says, well, we're fine with last year's statement, but we want the date of the report to be March 31st. I could come in and change the date of that previous report that would cover the December 31st date and change the date to March 31st. But I'm exposing myself to something called subsequent events that we're going to talk about later that would run all the way to March 31st. So I'd want to do some work to see that nothing that affected the statements that should have been included between, and now I forgot what I said the date of the previous report was, January 15th and March 31st. But I could reissue that report and not change my opinion. Let's say it could still be unqualified. What this says is when the auditor should ordinarily change the previously issued opinion, you're changing the opinion from, say, qualified to unqualified, unmodified, because the statements were restated to conform with generally accepted accounting principles. Hello?
Yes.
Yeah. So the client could ask that. They could ask for that. They may not even, maybe I'm going to be their auditor in the next year. So there may not even be a predecessor auditor involved, and the client could request that. Okay. All right, let's look at the next one. What, Mike? You're good?
I said understood.
Oh, okay. All right, good. Okay, great. Thank
Can I
you.
ask a question about the previous?
Yeah,
Could we go up
yeah.
on D? When it says a change in reporting entity, does that mean like they merged with someone or they changed their name? What does that mean?
Change in reporting entity, I think the more common example is, and I'll tell you a story if you don't mind on that. I had a former student calls me up like 10 o'clock at night one time and says, "I'm sorry to bother you so late, but I'm at work, and we had a client that last year hadn't consolidated a bunch of companies in their financial statements, and this year decided that they wanted to consolidate. So I have finished the consolidation for this year. I want to see if we're doing comparative statements, what do I have to do with last year's statements?" And my answer is, you have to consolidate those two. You have to get those same entities under, so if for comparative purposes, it has to be the same entity. So all I heard was silence on the other end, because I think she had bludgeoned her way through the compilation for the current year, and now realized she got to do it for the previous year. And if something like that happens, that's called a change in reporting entity. Okay. And what we talked about last time is that is something that would affect the consistency of the audit report. We'd have to add an emphasis of matter paragraph to the report that alerts the reader to understand that you're not looking at the same entity. Previous year, it was just one company. This year, there were other companies that were consolidated in.
Okay.
That's your change in reporting entity. Now, let me look at D. Prior year statements are restated following a change in reporting entity. And that prior financial statements are restated following a change in reporting entity. First of all, you wouldn't use the term restatement for that, because that, now I'm talking accounting rules, is something that we call a retrospective change, not a restatement. But basically what you do is you would have to, I guess you would say restate, because even though it's not technically called a restatement, it's called a retrospective approach. It's not a restatement approach. You do restate the previous period statements, as I've said, to consolidate those other entities. But you're not changing your opinion. You are simply reissuing your opinion with an emphasis of matter that calls out this different reporting entity.
Okay. Got it.
Okay, so I think we're having a nice discussion on this, guys, so I appreciate your questions. So I think the key phrase up there, okay, is ordinarily do what? Change the previously issued opinion. That means you went from one type of opinion to another, from, say, qualified to unmodified, unqualified. Okay, good discussion, guys. Okay, let's look at number 2 here. Oh, let me put the poll. Okay, we're at about 2 minutes, guys. So you want to go ahead and wrap up your choice here? Okay, I'm going to go ahead and end the poll. I think I got one person that's not answering this one, but you should always answer the questions, guys. Okay. So almost all of us got it right. Okay, the answer is C. Okay, but let's go ahead and take a look at this one. And we say that comparative financial statements include the prior year statement that the audit by a predecessor auditor whose report is not presented, okay, and the predecessor report was unmodified, the successor auditor, and now what? The onus falls on the successor auditor to modify our report. So we would have to what? Indicate in its other matters paragraph. It's not emphasis of matter paragraph, because emphasis of matter, remember from last time, guys, does what? Emphasize something that's disclosed in the financial statements. And it's unlikely that the company would have a footnote in their financial statements saying, well, somebody else audited our financial statements last year. That's not the kind of thing that goes into footnotes of financial statements, okay? They're talking about issues affecting the company's accounting in their financial statements and their disclosures and footnotes and whatnot, okay? We're going to call it out in our report, and when it's something that's in our report that we want to call out that isn't necessarily disclosed in the financial statements, that's an other matters paragraph. Okay? And the other thing too that made this wrong, okay, as I look at it more, what is all this limited assurance nonsense? What does that mean? I don't even know what that means. I mean, I know what expressing limited assurance does. Why would that be necessary in this situation? Okay, okay, good. Let's just go ahead and let's take a look now at group financial statements. I got to remember to go back to the main book. Okay. And let's first start out with, like I said, picture is worth several words. Okay. So let's just kind of get ourselves a picture of what's going on here. Okay. So what happens? You have Okay. Company A. And company B. Okay, and they're under the same ownership, and so what do? We decide that we're going to take company A and company B and consolidate them into consolidated financial statements. Okay, now using the language that we're talking about here, okay, company A would be considered a component. Company B would be considered a component. Okay, and the consolidated statements would be considered group financial statements. Okay, so we'd have component financial statements, and we would consolidate those, the company would consolidate those into consolidated or group financial statements. Okay, now what would happen? We would have a group auditor. We'll call them a group audit team. Okay, that is responsible for auditing the group financial statements. And then we could have one or more component auditors. So maybe we have some auditors that audit component A. Okay, maybe you have some auditors that audit component B. Okay. Okay, now that's what we're talking about here. Now, when we look at some of the language up here, okay, you have a component, okay, and then you have what? Group financial statements. Okay, so there's the group financial statements. There's the component financial statements, right? You have what? The group engagement team right there. Okay, group audit team, group engagement team, and you'd have a group engagement partner. Okay, so they're the leader of the group engagement team, obviously. And then you have what? You have your component auditors, right? Okay, now you may be looking at this and saying, well, why don't they just call it the consolidated financial statement auditor? And why don't they just call it the components, the subsidiaries? Why are they using these funny words? Well, there could be engagements like one that I was involved in which we're talking about components of a group set of financial statements, or even it could be called consolidated. It was in that case. For example, the engagement that I was involved in, we were auditing the consolidated financial statements of the federal government, but there were several departments that make up the consolidated. You have, IRS, you have public debt, you have Department of Defense in there, you have, EPA, Department of Agriculture, all these different agencies that make up the consolidated. And in that situation, even though, and it was written in legislation, that the GAO was the auditor of the consolidated statements, and it was called out that GAO would audit the public debt and the IRS directly, the remainder of the agencies would be audited by other auditors. Okay, so in that example, someone auditing, say, in the example that I gave, somebody auditing Department of Agriculture would be a component auditor. Somebody auditing Department of Defense would be a component auditor. I think KPMG still does audit Department of Defense. The GAO would be the group engagement team. KPMG would be the component auditor in that situation. Okay, so let's go ahead and let's start to understand then some of the responsibilities of the group engagement team. Okay, because they're going to be taking that work of some of the component auditors, and it's could potentially impact their report. Okay, and so the auditors, the group engagement team has certain responsibility about these people. They're almost, these component auditors, they're almost sort of like their staff. Okay, so what happens? They would have to make sure that the component auditors were independent, that they have professional competence. Okay, to what extent will the group engagement team be involved with the work of the component auditor? We're going to see that the component auditor has a choice of either referring to those, the group auditor has a decision of either referring to the component auditors or not referring to them in the report. And I think it's probably fairly obvious that if you're not going to mention them, you're going to have to be more involved in their work. In the case of the GAO, GAO made the decision not to refer to component auditors because there were several of them. GAO is the audit and investigative arm of Congress, so there was almost some politics involved in relying on the work of those component auditors. So GAO made the decision not to refer to them. And so we had teams that worked very closely with those component auditors, since we were not going to refer, and were really involved directly as part of their team. I was always on the part of the engagement where we did audit work directly. So I was directly involved in the IRS audit and the public debt audit. I could never understand why those people that were working with the component auditors always seemed to get a better bonus than I did, but that's a whole nother question, okay, beyond the scope of what we need to talk about here. Okay, now, what happens? You will need to make sure you will be able to get the information you need for the consolidation on a timely basis, and whether that component auditor operates in a regulatory environment, because you would need to be aware of the ramifications of that. So flashcard those things. That falls on the component auditor to do that. Okay. Now, coming over, the auditor will determine whether they're going to make, the component auditor will the group auditor will decide whether they're going to mention the component auditors or not. If they decide to make no reference, okay, so they're either going to refer to them or not. If they decide, okay, not to make reference, okay, then the group auditor assumes responsibility of the work for the component auditor, and no reference is made of those component auditors. Okay, so that's the case. Then the group auditor determines the type of work to be performed on the financial statements by those component auditors. They're really your staff then, and you direct their work. Okay, so flashcard that. Okay, when you do not refer, no reference is made, you assume responsibility. So let's just make that a flashcard here. Okay, you assume responsibility, and what? You're going to direct the work of those component auditors. And you can even put that on the flashcard: direct component auditors work. Okay, now, as we've said, since you're going to direct their work, okay, then you're going to want to direct their work in a manner, of course, that is efficient. Okay, so you would want to obviously direct their work towards significant components. Okay, and if you have significance due to financial significance or significance due to the risk of material misstatement. Now, we haven't talked about the risk of material misstatement yet, but if you have a more risky component that there'll be something wrong with the financial statements, you're going to want to do what? Direct more attention to those. Or if significance due to financial significance, that's the same as saying what? They are material. Okay, the bigger the component dollar-wise, or what? The bigger or the more. So I always say the biggest and the baddest. The baddest as it relates to a risk that there'll be a material misstatement. Okay, so what happens? We say that a component that is significant due to financial significance should be audited by the group engagement team or the component auditor. So either you're going to do the audit directly, which is the case with IRS and the public debt, IRS being the big heavy hitter on the income statement, public debt being the heavy hitter on the balance sheet. So the GAO audited those directly, okay? Or they need to be audited by a component auditor, but you're going to direct a component auditor, go and do a full-blown audit, and we're going to direct your work, okay? If it is a component that is significant because it is likely to include a significant risk of material misstatement to the group financial statements, the group engagement team or the component auditor should perform the audit. Okay, so in other words, material due to significant due to materiality, dollar amounts, or risk, then what? Then you're going to go ahead and make sure those get audited by either the group auditor or component auditors. Okay, flashcard that. Now what happens? If a component is not significant, then the group engagement team or the component auditor can do analytical procedures. We are going to talk about analytical procedures later, but analytical procedures are high level, and they are comparisons between last year's financial statements and this year's financial statements, or maybe we're looking at non-financial information to support information in the financial statements. Like if we're auditing a laundromat, we're looking to see how much water they used, and the amount of water may translate into washing machine revenue or something. But that is not as detailed as, you know, asking for confirmation of accounts receivable and whatnot. And if it's not if a component is not significant, either because materiality or risk, then we might turn to that lesser amount of work for that component. Okay, so we're doing that, directing that work up here at the group auditor, group partner level, depending on the significance of these components, and we're getting all that work that will fold into the consolidation, and we won't refer to the other auditors. Okay, now you're looking at all that and say, well, is there any way of getting out of all that? And the answer would be, yeah, option 2. Under option 2 now, okay, now we can go ahead and make reference to the other auditors. And I'm going to come back to that 1, 2 here in a second, but let's just take a look. When making reference to the component auditor, the audit report on the group financial statement should clearly indicate in the opinion section for the non-issuer, or the opinion, or on the opinion and basis for opinion section for our issuers, okay? And we will literally say there, okay, in that reference, okay, and let's see what we'll say in that reference, that the component auditor was not audited, okay, and you'll call out the component, and the magnitude of the portion of financial statements audited by the component auditor, okay? And so you would call that out, and you literally call it out as percentages, okay? Now I'm going to come back to those 2 requirements here in a second, where you're allowed to make reference, okay? But I want to look at the report real quick, okay? And notice in the opinion paragraph, notice you wrote that opinion the way you memorized, but you're saying, and based on the reports of other auditors. So you call them out, and then you get into this detail here where you literally talk about what amount they audited. The rest of the report is the same. That's why I keep pushing you on memorizing the report. If it is a public company, okay, again, you come in and you say, in our opinion, based on our audit and the report of other auditors, there's the paragraph in which you call out the details of what they audited, the 20%, all that. And then in the basis for opinion, you do tweak that a little bit to say, we believe that our audit and the report of the other auditors. Okay, so you do that there for the public companies. Okay, now, while we're talking about the public companies, you're allowed to not refer to those other auditors. Okay, if these requirements are met, and let's flashcard those. Okay, the component auditor has performed an audit in accordance with the relevant requirements of gas or when required by the PCLB, and the component auditor's report is not restricted to use. Then you have the option of referring to them. Okay. Okay, good. Let's come over then. And let's take a look. Yeah, I think another multiple choice question would make sense right here. Sufficient way to get there, but okay, here we go. Okay, we're at about 2 minutes now, and okay, good. Okay. And let's take a look at this one. Everyone had a chance to answer this. And yeah, choice D is the correct one. So 75% of us got that one right. Okay. But let's go ahead and let's take a look at this. And here, the group auditor decides what? Not to refer to the component auditor who audited a subsidiary. In this situation, the group auditor most likely would do what? Determine the type of work to be performed by the group auditor, right? You basically direct their work, okay? Did some folks pick what was, now I forgot. Some people picked what? C for some reason?
B, Professor. No,
D,
B.
document in the engagement letter that the group auditor assumes no responsibility for the component auditor's work. If you don't refer, then you absolutely are assuming responsibility for their work. That's why you're directing their work that you do. And show me where in the discussion we ever talked about engagement letter. Am I missing something, guys?
No, Professor.
Okay. If you don't refer to them, you're on the hook for the work that they did. As far as the user of the report's concerned, those other auditors don't exist. If they messed up, it's on you because you directed their work and you didn't catch what they did wrong. Okay. Okay, good. All right, let's come over and let's take a look at. You want a break or you want to go into the next module? Stupidest question ever asked, right? Okay, let's go ahead and let's take a break. Let's do 6:25. We'll come back. Or you want to go and then do this module and then take the break? I think this module will take us about 10 minutes.
I'm okay taking a break.
Okay, like I said, dumb question, right? Okay,
Yeah.
good. Okay, so let's go ahead then and reconvene at 6:25, okay? Okay, guys, let's go ahead and jump back in, talking about subsequent events. Okay, and what we'll really start out here at the very beginning is we started talking about really the accounting implications of subsequent events. So what happens? Let's say we have financial statements and the year end is 12/31. Okay. Now what happens? The statements don't get issued, okay, until sometime that next year. Let's use today's date as kind of an interesting day. Some state companies may issue their financial statements a month, a month and a half after the year end. Now, what happens? The world keeps turning, as you're sure very well aware. That's a turning world. The world keeps turning between 12/31 and 2/15 when the statements are issued. And what the accounting standards say is, look, a company needs to make sure that they include information, okay, in the financial statements that come to light during that subsequent period. Okay, this is the subsequent period. Okay, now we're going to see that responsibility, since we're responsible for making sure the financial statements follow GAAP, that responsibility to be aware of subsequent events and see that they're properly included in the financial statements per GAAP, that also falls on the auditor, because the date of the auditor's report will likely be this 2/15 date. Okay, so we take a look, and when we look at subsequent events, they fall into two categories. Okay, they are recognized subsequent events and non-recognized subsequent events. Okay, recognized subsequent event, we will literally make an accounting adjustment. When I say we, I'm talking about the company. We'll make an accounting adjustment. When I say accounting adjustment, what does that mean to you? That's a question. What'd y'all do? Go to sleep on me? Y'all there? Hello? Hello?
No, well, I'm here.
Okay.
Like an accounting adjustment, would that be like a change in depreciation method?
No. What I'm looking at there, Nicole, is the answer I was looking for is there'll be a debit and there'll be a credit to an account.
Oh,
Because there's a journal entry associated with that. Okay.
Oh.
So if we have a subsequent event, recognized means you will make an entry that'll affect the financial statements and there'll be disclosure about that event. Okay, so entities must recognize the effects of all recognized subsequent events. I mean, that's a little redundant. Okay. Now, these subsequent events provide additional information about conditions that existed at the balance sheet date. For example, settlement of litigation, okay, is a good example. And what flashcard that recognize subsequent events provide additional information about conditions that existed at the balance sheet date. Okay. For example, let's say we were being sued and the suit was filed in November of 2023. We come to 2024 and the case is settled, say in January, and say it was settled for $10,000 in January. I would be required to debit a loss for $10,000, assuming I lost the case. I would debit loss $10,000. I can't credit cash because I wouldn't have paid them, obviously, December 31st if I didn't know the outcome of the suit. I would debit loss and I would credit a liability due to some sort of, lawsuit or payable or something like that. And I would disclose the situation that, hey, the suit was filed in November and it was settled in January and this was the outcome. But since the suit had been filed in November, I have to make an adjustment. Question. Okay, loss on account receivable. What happens? I have a situation in which I have a client that files for bankruptcy in December of 2023. I find out that they're not able to pay me in January of 2024. Did the conditions exist at the balance sheet date? That's a question. They file for bankruptcy in December of 2023. I have a 2023 year end, let's say. They filed for bankruptcy in December 2023. I find out about it in January of 2024. I find out that they can't pay me in 2024. Did the condition exist at the balance sheet date?
It sounds like
I'd
Yes.
say yeah.
Yeah, okay, good. Okay, so what would I do? I would debit my allowance. I would credit the accounts receivable to write it off. Anything else I might do? I might debit bad debt expense and credit what? Allowance to put more in the allowance, because maybe when I debited the allowance, I took some out of the allowance and I thought, oh, I better put some more in. Right? But again, series of journal entries and disclose. If you see a CPA exam question that talks about subsequent event and they don't put disclosure as part of what it is you have to do, that's a wrong answer. Okay, well, it's a wrong answer if there's another answer that says make an adjustment and disclose. Okay, so you're going to disclose. Okay, now let me ask you a different question about this loss on collectible receivable. Let's say that the customer files for bankruptcy after the balance sheet date, but before the financial statements are issued. What should I do then? So they file for bankruptcy in January, and I find out about it before the statements are issued, say in late January, I find out about it. Now what? Did the conditions exist at the balance sheet date?
I said yes.
I don't think they existed before. No.
Okay, good. The answer of the standard setters is that what? The circumstances that led to the bankruptcy didn't happen the day they filed for bankruptcy. They would have been in motion, Gage, sometime well before the date of the balance sheet, or around maybe the date of the balance sheet, whatever, but before the year end. And so that would require the same treatment as the previous example. They didn't file for bankruptcy until then, where they had filed for bankruptcy before the year end. Okay. That's an easy mistake to make, and that's why I'm kind of having you guys walk through this with me. So you would still recognize that and disclose, of course. Okay. Okay. Now, non-recognized subsequent events. Okay. And I want you to put down here, no adjustment, but must be disclosed. Okay, so now what happens? Let's say for a non-recognized subsequent event, I have a client, and on January 1st, before the financial statements are issued, okay, or January 10th, let's just not make it the 1st, January 10th, before the financial statements are issued, there's an explosion and it destroys a factory building. Was the factory there at December 31st?
Yes.
Was, so I'm not going to make an adjustment to debit loss and credit the asset. But now there's a hole in the ground before the financial statements are issued. What would I do? Next to property, plant, equipment, I'd have C note 11. And there would be what? There would be a disclosure down there about this factory blowing up. Make sense? Okay. All right, good. Okay. And entities should not recognize non-recognized subsequent events. Whoever wrote this is probably an idiot. I hate people that understand things and then write them in a way so that it makes it hard for me to understand it. Entities should not recognize recognized subsequent events, you think? Okay, but what? But disclose. Okay. Okay, go ahead and flashcard that. Okay, good. Now, as you can imagine, this is putting some onus on the auditor to make sure that subsequent events are being properly accounted for and disclosed. Okay, so let's just take a look at the auditor's responsibility. How are you going to make sure that plants aren't blowing up after the year end, or companies aren't filing for bankruptcy, after the year end, but we don't, or even before the year end, and we don't find out about it until later, right? A lot of stuff going on. That world is turning, and that's putting a burden on us to make sure that before we issue the report, we catch those kinds of things. Okay, so the period between the date of the financial statements and the date of the auditor's report is called the subsequent event period. During that period, the auditor has a active responsibility to investigate certain subsequent events. Okay, and so the things that we're going to do, and guys, there's a mnemonic for this. In this version of the book, they got rid of mnemonics. But I typically don't like mnemonics unless they spell a word, and this one does. Okay, so you'll do a prime review. Okay, you'll look at post balance sheet transactions. Excuse me, why are you paying for a lawsuit in January? Was that the settlement of that one that was filed in November? Oh, it was? Okay, well then we need what? We need some recognition of that in the financial statements and disclosure. You get a representation letter from management signed, and we'll talk about rep letter later, but you ask them way towards the end, I think audit 5 or so, you ask them, you told us about all the subsequent events, right? And you make them sign that. Okay, inquiry. Okay, inquire about subsequent events. Okay, including maybe asking about litigation, claim, and assessment. We're going to do that. Minutes of the directors for subsequent period. Okay, because what happens? Something's being resolved in January, and maybe you have the minutes to the board of directors meeting for January, and they talk about the settlement. I've seen minutes where they'll talk about a suit and the settlement, and you start asking what suit, what settlement, and you might find out that that thing had already been filed before the year end and needs adjustment and whatnot. Okay, and then examine the latest available interim financial statements, because they're already preparing the statements. They're disclosing things in the interim statements that maybe should have been disclosed in the previous year end statements. Okay, all right, so flashcard what the auditor does in those circumstances. Okay, all right, good. So let's come over and let's take a look at auditor's responsibility after the report has been issued. So now our report has been issued. Do we still have some responsibility after the report has been issued? And we're going to see, and let's just read it here. The auditor has no active responsibility to make inquiries or to perform any further audit procedure to discover subsequent events after the date of the original report, except as described in the chart below, and I'm going to have you flashcard those in a second, okay? However, if the auditor becomes aware of information related to subsequent event before the report release date, the auditor should consider whether it's necessary to adjust the financial statements or related disclosures. So what's happened? We've already released our report, and now we find out that something that should have been included in the report was not. Okay, and that's where we're going to go with this. Now, for these situations identified below, the auditor does have responsibility that goes beyond the auditor's report date. Okay, flashcard these guys. Maybe you can shrink this down to a flashcard. These are very specific requirements. So maybe you can copy this page and make a flashcard out of it somehow. These are very specific things. I don't even feel like talking about them. Okay, but since they're here and there's an off chance that it might come up in a CPA exam question, flashcard. Other than that, you don't have responsibility that extends an active responsibility that extends beyond. However, if you become aware of something and you realize that that should have been disclosed in the financial statements, then the auditor will want to make sure that those things are properly either adjusted in the financial statements or disclosed. Okay, so what does the auditor do? You know, and this is a little bit of an oh, you know what moment when the auditor's like, oh, I forgot. Damn. Oh, I never paused the recording? I don't think I ever paused it. Okay, good. I never paused it, so we're okay. There'll be a gap. You can, when I get the recording up, you can just fast forward through the break time. Unless you want to, you know, watch blank space during that time. Okay, now what is the auditor action? And you're kind of having an oh, you know what moment when that happens. If information that materially affects the report and other person's reliance after issuance of the report, the auditor should advise the client to immediately disclose the new information and its impact in the financial statements. Okay, now when you say, well, what do you mean disclose it? Okay, you know, you might ask them to go ahead and reissue the statements disclosing that information or issue a press release or something, but you have to make sure that individuals relying on those statements are made aware of the thing that should have been disclosed. Okay, so you should flashcard advise the client to issue revised financial statements, advise the client to make the necessary disclosures if the statements haven't been issued yet. If the effect on the financial statements cannot be determined, then a notification to those relying on the statements and a notification to the stock exchanges, the SEC, etc. Okay, somehow there has to be appropriate steps taken by the client to make sure people know we swung and missed. We missed something that should have been included, and it wasn't discovered until after the balance sheet date. Okay, I mean after the report date, excuse me. Now come over and we'll talk about report dates in a second. Let's say something like that is found and you ask the client to do those things that we just talked about. Okay, when we say above, we mean on the previous page. We ask them to do those things and they say, here, we're not doing it. Okay, then what? Okay, well then if the client refuses, we will notify each member of the board of directors of such refusal. Okay, that's the first thing you do. Okay, so that's number one. Notify each member of the board of such refusal. You know, a lot of what we have in accounting and reporting standards and auditing standards are a prayer. And this is a prayer that the board of directors, the governance, you know, those charged with governance, the governance structure will work. It'll do its job. Okay. Now, if the board of directors is no good, the board of directors says, hey, you know, we're not going to do anything, but we're not notifying anybody. Okay. Who that member of the board of directors is. If I sound like a former president, I'm not doing that intentionally, okay? But they said, we don't care about, we're not disclosing anything, okay? If that's the case, notify the client that our report should no longer be associated with the financial statements, notify appropriate regulatory entities, and notify persons known to be relying on those financial statements. That's if management doesn't do what they're supposed to do and the board of directors fails to do what they're supposed to do. Hopefully, you'll never be in this situation. Okay. Now, what happens? Let's say, now going back, we're sitting there and, we dated our report, say January 21st. And we're getting ready to issue the statement, and then management calls us up and says, we were going to issue the statements on February 2nd, but we have a plant that blew up, and we want to disclose that in the financial statements. And so they go ahead and disclose in the financial statements, plant blew up, and they want on February 2nd. And they want us to erase January 21st as the date of our report and instead date it January 3rd. If you do that, you have taken responsibility for anything that might have happened between January 21st and February 3rd, which means you tell the client, well, look, we've got to go and do a prime review now between January, because we did a prime review between December 31st and January 21st. Now we have to do it again, all those steps that we talked about, to make sure nothing else happened between January 21st and February 3rd. And they say, management says, well, we don't have time for that. Your solution there would be to say, okay, we're going to dual date the report. Okay. So if adjustments or disclosure are made after the original date of the report, the auditor may dual date the report to extend responsibility only for that one subsequent event. Okay. And so an example would be saying, hey, for the rest of the financial statements, the date of the report is January 21st, and I'm just highlighting the example there, but for note 2 that talks about the plant blowing up or whatever it is, the date is February 3rd. Okay. Alternatively, what? You could erase January 21st in that example and put February 3rd, but you're extending responsibility for anything that might have happened in that subsequent period beyond where you had done your prime review. So that wouldn't be wise. Okay, so flashcard this point about dual dating. Okay, we already looked at what happens if the client refuses to disclose things that you felt should, and then let's just be disclosed, and then let's just go over to let's go look at this question. Oh, sorry guys, I keep forgetting tonight to put a poll. Okay, guys, we're coming up on 2 minutes now, so I'm gonna go ahead. I'm gonna wait for that last person who always comes in at the end and picks C for some reason. But let's just go ahead and take a look at, and I don't know if it's always the same person, but let's go ahead and let's take a look at this one. By the way, if there is something in your mind, okay, A is the right answer here. If you heard from some amateur that when in doubt, choose C for multiple choice question, that is nonsense. The examiners tell us that they have an even proportion of choices between A, B, C, and D. When I say even, you got a 25% chance of guessing a question correct. Okay, 25% chance. So if you're on the CPA exam and you can't possibly figure out what the answer is, try to think to yourself, have I picked a lot of A's? Have I picked a lot of B's? Does it seem like I'm a little heavy on the C's that I've picked so far on questions? And go with a choice that you think you haven't chosen much yet. Okay, don't fall into that silliness. When in doubt, choose C. That's people say all kinds of things about taking the CPA exam when they actually have done absolutely no study or research as to how the exam is structured. Okay. All right, good. Let's go ahead and let's take a look at this one. And as of August 13th, the CPA had obtained sufficient appropriate audit evidence with respect to field work on engagement to audit the financial statements. Year ended June 30th. On August 27th, an event came to the CPA's attention. Maybe management asked them to come and look at it. That should be disclosed in the notes of the financial statements. The event was properly disclosed, and the DCB decided not to dual date the report, but change the date of the report to the 27th. Well, now that CPA has taken responsibility for anything else that might have happened between August 13th and the 27th. Okay. C is what happens when you would have dual dated the report. Then you would have limited your responsibility to specifically called out other dates for specific events. Okay. All right. Good question. All right. Let's go. And I think what we're going to do, guys, is do one more module tonight. We're going to save that last module because it's not a really hard module, but you got to sort of focus. And I'm thinking we've given you a lot of information tonight, and I don't want to sit there and now get into that kind of, you got to kind of focus to really understand what's going on when we're providing an opinion on statements that are prepared using another basis of accounting other than GAAP. So we're going to put that off till next time. And then we'll definitely get into chapter 2 next time. I want to do this module though now so that you got a good set of material to work on over the weekend and during the week next week for chapter 1. Okay. All right, good. Now we say here that frequently audited financial statements are incorporated into other documents such as an annual report. Okay. Let's just do a little picture here. This is what happens. Okay. So you have the financial statements. And we know that the auditor has an opinion on those financial statements. Right? The auditor's opinion is on the financial statements. Now, what happens? GAAP may require that an entity provides supplemental information. Now, this supplemental information is not the financial statements. Thus, the word supplemental, it supplements the financial statement. The auditor's opinion really just extends to the financial statements, not that other information. Okay. And then entities may pick up that whole reporting package and include that in, say, an annual report. Okay, and that's specifically called out there. And so the question starts to extend. I know my opinion covers the financial statements, not the supplemental information, not the annual report, but do I have to modify the auditor's report if there's something wrong with that stuff that my opinion does not cover? And the answer is yes. You're going to have to call out some of this other stuff, maybe if there's something wrong, or just to acknowledge that it's there, even though you didn't audit it. Okay. So again, we're focusing on how do we modify, how do we tweak the unmodified, unqualified report when something like this has, is involved. Okay. So let's just go ahead and take a look. And auditor's responsibility, okay? And generally, just highlight this, generally an auditor is not responsible for determining whether other information contained in the financial statements is properly stated. However, okay, and here comes our responsibility, and I'm gonna have you flashcard. The auditor should read the other information, okay, to see if there are material inconsistencies between the audited financial statement and the other information. Okay. Now, material inconsistency, and they give us some examples here. Revenue, the annual report says revenue was 20 million when we know it was 5 million. Okay, that's a material inconsistency. Okay. And so, if there are material inconsistencies, if the audited financial statements require revision, then have them fix the financial statements, right? I mean, that's kind of obvious. But what if the other information, and if they don't fix it, then that's going to cause a modification of the opinion. I think we know that. But what if the other information, because our opinion doesn't cover that other information, so what should we do there? If the other information requires revision and management refuses to make, the auditor should communicate the matter with those charged with governance and, let's flashcard all this, consider the implications of the audit report, withhold use of the report, or withdraw from the engagement. Okay, now when we say consider the implications on the auditor's report, okay, and so let's take a look. Right here, reporting on the other information. This is what I want to look at. For the audit of a non-issuer, the auditor should reference the other information in the audit report on the financial statements by including a separate section with the auditor's report with the heading other information or other appropriate heading. The section of the auditor's report should contain a reference to the other information and language clarifying the auditor's responsibility. And if there is a material misstatement of fact in that other information, then the auditor should do what? The auditor should call that out as a problem. You're not qualifying your report, but you're simply saying, hey, there's a problem. Okay. But regardless, you have to do what? You have to call out that information, say that they're responsible, and your responsibility is to read the information for material inconsistency. And if such a inconsistency exists, you would call it out there. You'd say, hey, they said the revenue is 2 million, 20 million, whatever, when in fact it was 5 million, going back to that example. Okay. Question. Okay. Now, that's the other information. That's the annual report. But we also had that. Okay. So what we were talking about there, reading it for material inconsistency and stuff, I guess I should have made that a little more clear. We were talking about what? The annual report situation. What is our responsibility for the supplemental information? Which notice is getting closer to the financial statements? Okay. So let's look at some of that. Okay. And you come over. And we talk about reporting on supplemental information. Okay, supplementary information is information presented outside the basic financial statements that may be presented in a document containing the audit financial statements or separate form or separate from the financial statements. You know, a example here, and I might as well mention it. Well, no, I'm forgetting what class I'm in here. I'm not in the bar class, I'm in the audit class. But when we talk about government reporting, the Governmental Accounting Standards Board requires that entities provide information about certain infrastructure assets like bridges and stuff. They're not part of the financial statements, but they have to include additional information about them, supplemental information. That's the kind of thing GAAP requires it as supplemental, but it's not part of the financial statements. Okay, so what happened? An auditor may be engaged to report on the supplemental information in relation to the financial statements as a whole, and we would have two objectives in such engagements. Now, they say they may be, so we'll see later. It may be that you're not required, you may be that you weren't engaged to report on that, and then we'll see that there's a different requirement there, okay? Notice though that we have two objectives, and we are seeing that the information is consistent in relation to financial statements as a whole, and then to report on whether supplemental information is fairly stated in relation to financial statements taken as a whole. Now, this is if we are engaged to give an opinion, okay, on this. Now, in order to do this kind of work, okay, which is going beyond what we're typically doing in just a straight audit, okay, conditions for doing this is, okay, the information was derived from the financial statements. The information relates to the same period. The financial statements were audited by the auditor. Now think about that. How can we give an opinion as to whether something reconciles in relation to financial statements taken as a whole unless we audited the financial statements? So you audit the financial statements, and then you may be engaged to go further and start to give an opinion on that supplemental information. You can't have adversed or disclaimed on the financial statements because the financial statements are the foundation for the supplemental information. If you disclaim, how can you say I have or adverse that you have the appropriate foundation to give your opinion on the supplemental information, okay? And the supplemental information accompanies the financial statements, okay? Flashcard that management is responsible for what? For preparing the supplemental information, providing the auditor with a written representation. So now you're going to ask them, hey, give me something that says you prepared this information appropriately, okay? Okay. Yeah, just flashcard those couple of ones for management's responsibility. Now, what are our audit procedures? Okay, let's just go ahead and take a look at the audit procedures where you have chosen to be engaged to give the opinion on the supplemental information. Okay, and so let's take a look, and I don't delete that. I don't cross that out. I want to highlight it. Inquire of management regarding the supplemental information. Determine whether the form and content of the information complies with the applicable criteria. Obtain an understanding of the method used to prepare the information. Big one. This is the big one. Compare and reconcile the information from the audited financial statements, because we keep saying in relation to financial statements, right? If there were any assumptions, what were they? Evaluate the appropriateness and completeness of information. Didn't we already say that about getting written representation? Oh, we say that management is required to give written representation. And so obviously the auditor needs to obtain that, okay? I typically don't stop on these PCAOB things because they sometimes have, redundant information, but a couple of things. The auditor generally should use the same materiality considerations that they use for the financial statements, okay? And the auditor should accumulate misstatements on the supplemental information and communicate those to management. So you could do a separate flashcard or just keep going with that same flashcard as to audit procedures, and then just include that these last couple are specific to public companies. Okay, now let's take a look at what the report will look like for non-issuers. Okay, and so presentation, the auditor's report on supplemental information may either be presented in a separate section of the auditor's report on the financial statements with the heading supplemental information, or in a separate report. Okay, you have that option. So you could just add a paragraph with the heading sample supplementary information to the audit report, or issue a separate report. Now, if there's a separate report, okay, the report should include a reference to report on the financial statements, the date of the report, the nature of the opinion on the financial statements, and any report modifications. Okay, so go ahead and flashcard that. When we say report modification, we mean report on the audit of the financial statements. Okay, so the reports have to point to each other. The report on the financial statements is a separate report. We'll say, hey, take a look at that report on the supplemental information, and the report on the supplemental information will point back to the report on the financial statements. And if there was some modification of the opinion, qualified, couldn't be adverse, because then we couldn't do this work, then you'll call that out in the separate report. Okay, let's take a look at material misstatement. Okay, and if the auditor concludes that the supplementary information is materially misstated in relation to the financial statements, and the management won't fix it, modify the opinion for qualified or adverse. This is the opinion on the supplementary information, not on the audit report. And then they tell us if a separate report is issued on supplemental information, withhold the report. Flashcard that, but I have something to say about this here in a second. Okay, well, let's just take a look at the discussion down here. When the auditor report on the audited financial statements contains an adverse or disclaimer opinion, and the auditor has been engaged in reporting the supplemental information, the auditor is prohibited from expressing an opinion on the supplemental information. I think we've already said that, but I think that's worth making sure that you have in a flashcard. Okay, and let's come over and let's look at presentation of the audit report. Okay, and unless prescribed by regulatory requirements, the auditor may either include the report on supplemental information as an explanatory paragraph in the auditor's report, or issue a separate report. Okay, and then again, if the audit report issues a separate report to supplemental information, the report should identify the auditor's report on the financial statements. Okay, let's look at report date for this supplemental information and flashcard this stuff. Okay, and the date of the auditor's report on the supplemental information should not be earlier than the date of the report on the financial statements. Just keep thinking of this, everything is leveraging off the audit of the financial statements, right? Okay, from what the information was derived. The date of the report, the auditor obtained appropriate evidence to support the supplemental information, but it can't precede the date on the financial statements. Then you may be doing additional procedures after the date of the financial statements to get comfortable with the supplemental information, then that would become the date of the report. Now, you come over and we talk about material misstatements. Okay, if the auditor determines that supplemental information is materially misstated in relation to financial statements as a whole, describe the material misstatement in the report on the supplemental information and express a qualified or adverse opinion. Now, we saw that, and we saw that if that's the case, you could qualify or adverse the supplemental information or withhold the report. Remember, it said that. Then they say inability to obtain sufficient audit evidence. And we say if the auditor is unable to obtain sufficient audit evidence on the supplemental information, you can disclaim the auditor should disclaim an opinion on the supplemental information. But what's bothering me here is they don't call out that if it's a separate report, the report should be withheld for a disclaimer. But they say up here that you do it if it's a qualified or adverse for material misstatement. And so I have the question into Becker. This is bothering me. This seems weird here. That if it's a separate report, you withhold the report. And they're saying you do it for material misstatement, but then in the supplemental information, but if you had to qualify, they don't say withhold the report. My spidey senses are telling me something's not quite fully described here. So I've got a question into them, and I'll get back to you guys as to what it is. Okay, that if that's correct the way it is, then so be it. I mean, sometimes the standards have weird things in them. Okay. Question on that? Okay, good. Now come over and required supplemental information. And guys, I apologize. I should have probably talked about this first but the book has it out of order, and I forgot that I wanted to talk about this first. Because what we just got done talking about there in section 2 here in this module is the situation where the auditors engaged to go beyond the general responsibility for the supplemental information and actually issue a report and give an opinion on the supplemental information. That doesn't have to be the case. Often it is not. Often the auditor issues the audit report and they give no opinion on the supplemental information. But because that supplemental information is right next to the financial statements, the auditor does have some limited responsibility on all audits as it relates to that supplemental information. Okay, so let's just go ahead and see what the required procedures are. Okay. In the absence of any separate requirement, particular engagement, the auditor's opinion on the financial statements does not cover the required supplemental information, okay, unless we're asked to do that, okay? But we still have the following required procedures, okay? And this is on all financial statement audits. You have to do this part as it relates to supplemental information, okay? Inquire management about the methods used to prepare the supplemental information, determine if the information is consistent with management's responses, and obtain written representation regarding that required supplemental information. Okay. Now, let's see what happens. Separate required supplemental information section, the auditor's report for non-issuers on financial statements that include a separate section, the audit report on the applicable financial with in language to explain the following. So you're going to add a paragraph to your standard audit report. Okay. It's not going to be giving any kind of an opinion on the supplemental information, but it's going to be talking about that information, whether it's there, etc. Okay. So you would say, hey, the required supplemental information is there, or it was omitted. Okay. And so you'll have to acknowledge its presence or say that they didn't provide it, but you're not giving an opinion on it. That last section that we just talked about in 2, yes, you were giving an opinion, but that's for engagements that aren't always the case, where we go beyond the basic requirements that we're talking about here. Okay, and Becker should flip that in the book. I'm not sure why they put this that happens on all audits, and then they brought the one-off case up first. Okay, now you come over and they tell us an opinion is permitted And that would have been a perfect place to start the discussion that we talked about in section 2. I don't know why they've got that flipped in terms of the logical flow of it. Question? Okay, good. If there is not a question, let me put up a multiple choice question, our last of the evening. Okay, let's try this one right here. I'll put the poll. Okay, looks like everyone got a chance to answer this one, so I'm going to end the poll. And yeah, most of us got this right, okay, just about everybody, but let's look at this one. Because again, I feel in part the way this was presented in the book throws you off a little bit, but the auditor non-issuer, what is the auditor's responsibility for supplemental information such as disclosure of pension information, which is outside the basic financial statements? So we're talking about that box around the financial statements. Now, I said that the auditor's opinion does not extend to that supplemental information, but the auditor has what? Limited responsibility associated with it. And we talked about what? The procedures that the auditor would perform around that supplemental information. So the opinion doesn't cover it, but it is not true that the auditor has no responsibility because it's close enough to the financial statements that we have to look at it, right? And see that it's there and whatnot, okay? We aren't going to apply test to it. You start applying test when you're trying to give an opinion. So substantive test was the dead giveaway phrase there that that's the wrong answer. The auditor's only responsibility for the supplemental information to determine that it has not been omitted. No, we even have to call it out in the report that it's there, don't we? Okay, so no, you have to apply those limited procedures. Okay, so I think what would have helped with this question, and I have it written in my notes, and I forgot to show it to have you put that there. So let me go back to the textbook, the current textbook, and why don't we go ahead and call these what? Required, but let's call them what? Let's call them what they are. They are limited procedures. Okay, you're not going to be doing test work. You're inquiring, determining if it's consistent with management's responses, and get a written representation about it. Okay, and then you're going to look at it and see if it's there, right? And if it's there, say in your report, hey, it's there. I'm not giving you any sort of assurance on it, but it is there. Or if they haven't provided, then you're gonna say you provide it, but it's not affecting your opinion. It's what in a separate section with the heading, required supplemental information. Question? Okay, guys, I think that's sufficient work for tonight. We're gonna go ahead and we will pick up with module 11 and then jump into chapter 2 on next Thursday. Okay, any questions, concerns? Okay, guys, then I will see you next week. Have a good rest of the week. And I'm gonna be looking at your homework, so make sure you're keeping up with things, okay?
Thank you, Professor. Good night.